U.S. stock market roughly shrugging off tariff concerns, but Hong Kong's market closing lower after President Donald Trump teased out tariffs on Canada, Mexico, and China, all set to start on February 1st. Investors now looking ahead to Trump's planned remarks at the World Economic Forum for potential insight into those policies. For more on the global trade reaction, we've got Jeffrey Kleintop. He's the chief global investment strategist at Charles Schwab. Jeffrey, great to speak with you. A lot to talk about when it comes to the global trade, specifically in currencies, which we're going to get to. But I want to start on where the tariff risks are accurately priced into global markets. Where do you think the risk is accurately priced versus areas of the globe that need to rethink pricing of tariff risks?
Well, I think setting aside currencies, looking at equity markets, we've certainly seen a difficult period in the fourth quarter for European equities and Chinese stocks. Those two areas are certainly in the crosshairs of the Trump administration. But Mexico and Canada have done a little bit better, and that's one of the things that's interesting. I think maybe even gains, I think every day this week in Mexican and Canadian equities, there's some potential risk there given the sizable amount of trade between those countries and the U.S., and the fact that they really haven't priced in very much there on that front. So I'd say Europe and China look a little bit better positioned heading into what could be a whole new regime for trade, whereas Mexico and Canada maybe a little bit more downside.
Jeffrey, let's talk a little bit more about your base case. Goldman was out with a new note here last night talking about the fact that they actually lowered their odds for President Trump to implement some of his more aggressive rhetoric when it comes to tariffs. What are you expecting?
Yeah, that's our view as well, is that a lot of what Trump has talked about isn't really economic policy when it comes to tariffs. It's statecraft. It's really about gaining concessions in other areas, whether it's on immigration with Canada and Mexico, whether it's on many different factors. Energy is one of the areas where I think you might want to focus on. Trump's team is very keen to lock in long-term deals for Europe and China to buy a lot more U.S. oil and gas, much more production, much more of the sales overseas to try and narrow those trade gaps. That's one area where you could see maybe an opportunity here from a sector perspective. The energy sector, actually the best performing sector so far this year, recognizing Trump's support for that sector, more about U.S. energy dominance than it is so much about tariffs.
And your estimated overall tariff rate, it seems relatively high given those tariffs that Trump has already teased out. And obviously those are different from what he said on the campaign trail. But walk me through how you're getting this projection and the impact you think it could have on the sectors you just mentioned, but also kind of the macro level.
So this is, if you add up every tariff that Trump talked about on the campaign trail, you get to a number of 26% for the U.S. average weighted tariff, up from 2.6%. That's a huge move, higher than we even saw going into the Great Depression with those Smoot-Hawley tariffs. But we don't think that's in any way likely. We think something more, maybe a net increase of somewhere between 5 and 10% in terms of the weighted average U.S. tariff. And that's something that's really quite manageable when you take a look at what it means for U.S. economic growth, exports, and imports. As a matter of fact, I think there are a number of currencies and countries around the world that are braced for a far more negative outcome than so far, I think, what we're likely to see. Remember, back in May, I think it was May of 2019, Trump talked about imposing a 25% tariff on Mexico, but he never did because Mexico came forth and put forth some efforts to secure the border. And that's the exact same type of thing Trump's looking for this time. Trump also cut a big phase one trade deal with China. He renegotiated the USMCA with Canada and Mexico, and even renegotiated trade deals with Japan and South Korea. So I think he could make some deals, something we didn't see under the Biden administration.
Jeffrey, in terms of what you're expecting and what's been priced into the market, very much argument has been made time and time again that the markets are very much going to be used almost as a check here for President Trump and his administration, just in terms of the policies and what is going to be implemented here. Is the market, though, still a bit too optimistic about how the tariff playbook is going to play out?
I think there was a sense of relief that big tariffs weren't actually implemented on day one. But it's still early, and the honeymoon could end soon. Again, I'm focusing on those areas that could be better positioned, like energy, with regard to Trump than necessarily some of those areas. Look, we've seen stocks come down. I think yesterday we saw stocks like that have a lot of China sales, like Starbucks, like Skechers, like GM, like Tesla, really suffer a little bit. They pull back on the idea that Trump is quite serious about an additional 10% tariff on China. And of course, China would likely respond in kind. So there is some risk to some of these stocks, and some of them have been high flyers. They are at risk of further developments here on the trade war front.
Let's get to those currency issues as well. We're seeing the dollar weakening versus the yen ahead of that Bank of Japan decision. It makes me wonder more broadly about whether central banks or policy from the White House are going to drive markets this year. What do you think?
Yeah, I think it's probably a bit of a shift. We're pretty much locked in on the outlook for relative central bank moves this year in terms of what the Fed, Bank of Japan, European Central Bank are likely to do. So I don't think we're going to see much of a deviation from that. Unlike last year where expectations changed dramatically, I think we're on a pretty set path with regard to the deviation in rates. So I think it really does come down to incremental changes in trade policy. Remember, the textbook reaction for a currency of a country that imposes a tariff is it for it to go up by the amount of that tariff. And we've seen that in the past. During the first Trump administration, we saw an incremental 16% new tariffs put on China, and that's exactly how much the dollar rose versus the Chinese currency. Same thing lately between the U.S. and Mexico. The Mexican currency has fallen 20% versus the dollar in anticipation of some new tariffs there. So that's actually where I think we're seeing more of the drive in currency in 2025, really around tariffs. And again, if we are getting fewer than what the market's braced for, well, that could be bad news for the dollar.
And when you think about the risks of a potential carry trade unwind, something that we saw lead to a brief sell-off in the market in 2024, how likely do you think that is this year, and is that risk priced in?
I think that the risk is relatively low. And one of the main reasons is that what we saw going into the Bank of Japan's rate hike back in late July was a big imbalance in the futures market. There was a record number of speculators betting against the yen, and they had to quickly cover those positions by selling assets in other markets. That is not the case now. Positioning in the futures market is fairly neutral. This one has been very well telegraphed. Now, that isn't to say there's still a lot of borrowing in yen that is now long into tech stocks and other things that may unwind over an extended period of time, let's say over the next several months. But I don't see a sudden reaction driven by the futures market move like we saw back in last summer. We're just not positioned the same way.
All right, Jeffrey Kleintop, thanks so much.